Everyone thinks a mutual fund is just a bucket where your money sits. It's not. Most people picture it like a savings account. You put money in, a manager watches it, and your balance grows. Simple, but that's the comfortable lie. In reality, a mutual fund is a legal structure that pools cash from thousands of people and uses it to buy stocks, bonds, or other securities in bulk. The fund itself doesn't own anything. You do, and that distinction matters more than you'd think. Here's how it actually gets built. A company, say, a firm with 100 portfolio managers, creates a fund. They write a prospectus, which is basically a rulebook. It says, we're going to buy mid-sized tech stocks or government bonds or a mix. Then they register it with regulators. Only then can they start selling shares to regular people like you. When you buy in, you're buying shares of the fund itself, not the underlying stocks directly. If the fund holds 100 different companies and you own one share, you own a tiny slice of all 100. The fund collects everyone's money into one pot. That pot gives the manager real buying power, millions of dollars to negotiate better prices, lower transaction fees. You couldn't do that alone. The manager's job is to follow the fund's stated strategy. If it says growth stocks, they buy growth stocks. If it says bonds, they buy bonds. They're not flying blind. They're constrained by the prospectus. And here's the part that changes everything. They charge fees for this, not a flat rate. A percentage of your assets every year. That fee gets deducted before you see your returns. Two types exist. Active funds have managers making constant buy and sell decisions, hunting for bargains. Passive funds track an index. They just mirror what the S&P 500 does, for example. No hunting, lower fees because it's mostly automated. Both are structured identically. The difference is in the strategy layer on top. When the fund's holdings pay dividends or interest, that money goes back into the pool. The manager can reinvest it or distribute it to shareholders. Either way, it's tracked. When you sell your fund shares, you get your slice of whatever the fund is worth at that moment. If it's worth more than when you bought in, you've gained. If it's worth less, you've lost. The real engine is diversification. By owning hundreds of small positions instead of a few big bets, the fund smooths out the damage when one company tanks. You're paying for that insurance in the form of fees. The manager isn't magic. They're a curator managing risk through sheer volume and discipline. That's the trade, cost for safety. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you can understand the mechanics behind every financial product in your life, not just the pitch. This video is for educational and informational purposes only and is not financial advice. Always do your own research.